Hi, and welcome back to the Business Career College video series. In this video, we're going to look at bond duration. Now, this is not something you will need at the life license qualification level, nor for mutual funds course. This is really only for any of your financial planning exams. And I would suggest that the likelihood of actually seeing a question on at least FPE 1 on bond duration would be low. On FPE 2, maybe. So FPE 1, I would suggest this is unlikely, but still possible. And really, a question about bond duration is probably going to be more thematic. That is, what are the characteristics of a certain type of bond rather than mathematical? That is, calculate the duration for this bond. That's actually something that would be um, possible, and I'm going to show you how to do it more because I want you to understand what it is. On FPE2 it would be possible, but even then something of a stretch. Bond duration is a concept that's really used by analysts and fund managers when they're making determinations about how to build a portfolio of bonds. So to see duration in action, I'll show you something here. We'll go through a bond. So let's say that I have this bond. I have a bond here with 8 years to maturity. And my bond has a par value of $1,000. We'll just keep it easy here. And a coupon rate of, let's say, 4.25%. Okay. And let's say that currently interest rates are 5%. So presently interest rates are 5%. So this bond we can see will be selling at a discount because it's less than the current interest rates. So we're going to calculate the price of this bond, and we can draw our line. So I know then that I'm trying to solve for the price. I know that along the way I'm going to have 2 payments per year. I know that each of those payments is going to be based on $1,000 times 4.25% divided by 2, and I know I'm going to get $1,000 at the end here, and I know that I'm working in a 5% interest rate environment. Okay, so I can solve all that out. PYR times PYR, IYR, PV, payment, future value, and bonds are always solved in end mode. So my PYR here will be 8 years to maturity. My times PYR at 2. IYR, we're in a 5% interest rate environment. My PV is what I'm solving for. Payment is going to be $21.25. And my future value, of course, 1,000. And these values will both be positive. I'm getting my coupon and I'm going to get that future value. So now I can solve that. Sorry, I just realized I screwed up my PYR and times PYR. That's a rookie mistake there. Let's fix that. So my PYR here, we're on 2 PYR, even wrote it right up here, and 8 for our times PYR. So as predicted, we have a bond selling at a discount here. You should have gotten a present value of $951 and 0.44 cents. Okay, that would be the price for that bond today on the bond markets. Now that we know that, let's have a look at a little bit of a what if scenario. Okay, so my what if here is what if interest rates change? Okay, so let's say that interest rates go up to 6%. So we have an increase in interest rates, and we know when we have an increase in interest rates, we're going to see bond prices fall. So it's a 1% change. And what I would like to know here is what's the extent to which interest rates will change here, or sorry, to which my bond price will change. Well, if I've just kept my values in my calculator, of course, I can change this to 6 now, and I can resolve. So if you change your interest rate here to 6%, or change the yield to 6%, we're going to change the price as well. And the new price of this bond at a 6% yield will be $890.090 or 90 cents. Or if we change it in the other direction, if we go to 4% instead, so we knock that down to 4%, then we're going to end up with a price of $1,016.972. Now this is where this gets a little bit complicated, but just bear with me here. So if I take this 890.090 and I figure out the difference between 951.044, so 951.044 minus 890.090, that gives $60.95.4, which as a percentage of my original price, the price that we started at here, the 951.044, gives me about 6.4%. So we've had a 6.4% change in interest rates. Now, you'll find that if you do the same calculation for the price change down to 4%, you'll get a slightly different number. You'll get 6.9%. So this is where we get into some very high-end concepts around duration, and this is where you have to, if you really want to delve into this, understand that there are two kinds of duration in reality, and the true calculation for duration is a little bit more complex than this. That's where we get into a discussion around two kinds of duration. One is Macaulay duration, and the one that we're using here is what's called modified duration. They both measure roughly the same thing. There are some subtle differences that you would really only care about if you were doing some very high-end investment analysis. Regardless, we have arrived at a useful figure here. We'll use our 6.4%. So what this 6.4% represents, this represents the change in the price of this bond based on a 1% change in interest rates. So to what extent will this bond move in price based on that change? It is, for the most part then, a measure of volatility. That is, if we have a swing in interest rates, how far is the price of my bond going to move? So the higher duration we use, the higher the volatility. And now that you kind of see how duration is calculated, you could run through all kinds of different bonds and measure this. There are some principles that we can apply here when we look at duration. In general, what you would see is that a bond with a lower coupon rate is going to be more sensitive to a change in interest rates. It's going to have a higher duration, and also a bond with a longer term to maturity or a longer term to call is also going to have a higher duration. So I hope that helps to explain duration. That should help you to get through any exam questions around duration. The result here really is that if you have somebody who is relatively risk tolerant, they're generally going to choose bonds that have higher duration. So that would mean bonds with lower coupon rates and bonds with longer term to maturity. If you've got somebody who has lower risk tolerance, maybe because they have shorter objectives or whatever it happens to be, or shorter time horizons, then they generally want bonds that have higher coupon rates because they're going to have less duration. That means less sensitivity to a change in interest rates. And they're going to want bonds that are relatively shorter, that have a shorter term to maturity, because they're also going to have less sensitivity to interest rates. If you've got somebody with a long time horizon and great risk tolerance, then choosing these bonds with these higher durations should not represent a problem. I hope that helps. Please let me know if you have any questions, and thanks to Devin for posting the question that led me to create this video.